So as you noticed, there's been something that's going on in the market for the last week or so, and it's a sell-off. And this sell-off has created some incredible buying opportunities. And today, I'm walking you through the 3 income ETFs I'm focused on right now and why staying calm might be the smartest move you make this year. We're talking mindset, income investing, and how down economies can be an accelerator for building your wealth. If that's got you curious, then stick around. I got you covered. Welcome back everyone. Rico here. From my experience working with tech leaders, creatives, and entrepreneurs in my coaching practice, I've learned something really important. We're really great at staying calm at work, but we panic way too fast when it comes to the economy and the markets. And I get it. Economic pullbacks feel scary lots of the time. Headlines get super loud and everyone starts making bold predictions and everyone is predicting something different. But this is where long-term investors, they separate themselves from the short-term traders. I'm going to share with you why I'm doing it and the 3 income ETFs I'm adding to right now. Remember, this isn't advice. This is just my thinking, my strategy, and how I stay grounded when the markets get a little crazy. But first, I want to start with some context, with the bigger picture, because understanding what's driving these moves, that can help us stay more level-headed. So first, we'll talk about the job market. Well, the job market is still strong, but it's clearly slowing down. ADP's latest report came in below expectations, and that tells me that hiring is softening. Job openings have dropped from over 12 million at its peak to the mid 8 million range, and that's a massive decline, and then companies are being more selective. So that's almost a 4 million job decline, and companies are being more selective about who they hire. On top of that, layoffs are rising slowly, I have to admit, but nowhere near recessionary territory. And what a cooling job market usually signs is that there's slower growth. And a cooling job market usually are signs that there's slower growth. But it also leads to higher volatility, and higher volatility means stronger income premiums for the ETFs we'll talk about later in the video. And this is exactly the environment where options overlay income, those kinds of funds tend to shine. Next thing on the list is inflation. Now, inflation has been trending down from the highs, but it's still not where the Fed wants it to be. Core inflation, the one the Fed actually cares about, is still elevated. The biggest pressure points are shelter, insurance, medical services, and transportation, not to mention the tariffs that have been going on. And the Fed's preferred measure, core PCE, is improving but too slowly to justify aggressive rate cuts. And sticky inflation keeps the market nervous. But for income investors, it's actually not the worst thing because uncertainty keeps premiums elevated. And next, let's look at the ADP and Fed data. It's not a collapse and there's a clear slowdown. And the latest ADP report shows that hiring is slowing, wage growth is cooling, and small businesses are even starting to cut jobs, which all sounds really bad. And the Fed is stuck between 2 realities. 1, that inflation isn't fully solved, and 2, the job market is weakening. So they're sticking with the higher for longer language. Markets tend to hate that. And you and I, we can see some opportunity in it because again, volatility equals income. Next, let's talk about what that means for me and maybe you. Here's the summary I am working from. So 1, the economy isn't collapsing. Growth is definitely slowing. Inflation has been stubborn. The job market, yes, it is cooling. The Fed is being cautious. Volatility, yes, it is rising. But with that, prices are cheaper and yields are higher. Now, this is a recipe for long-term income investors. And this is the season when the markets are like this where I stay consistent, stay calm, and stay connected to my framework and my long-term strategy. So now let's talk about the 3 income ETFs I am buying, and they all will make sense when you hear them. So the first one is SPYI, the NEOS S&P 500 High Income ETF. Current price as of the recording is $51.48, and it has around a 12% trailing 12-month distribution yield, and the expense ratio is around 0.68%. So what I like about SPYI is it gives me broad S&P 500 exposure and a high income overlay, so I get paid pretty well. It's a core, steady, reliable income ETF in my portfolio. And when volatility picks up, SPYI's distributions usually stay healthy. So my move in this environment is to continue to add to SPYI consistently during the sell-off. It's one of the easiest, sleep at night income positions for me. The distributions are steady Eddie. Next one is quite the same. QQQI, the NEO's NASDAQ 100 high income ETF. Current price around $53. It has around a 14% distribution yield and has the same 0.68% expense ratio. And what I like about QQQI, and this is my growth plus income play. That's what I like about it. I still believe in tech. I still believe in AI, and I still believe in the companies driving innovation. They will usually bring us through economies like this. And QQQI gives me that upside, but also paying me every month. So I'm continuing to dollar cost average into this and layer into it. Not all at once because tech volatility can cut both ways, but for the long term, I love QQQI, one of my favorites. And the third on this list may be controversial, but this is the future of the workforce for me and the future of where computing is going. And that's AIPI, the Rex AI Equity Premium Income ETF. Current price is around $41 with a 38% distribution yield and a year-to-date return so far of 16%. And what I like, this is my high-octane income ETF. It's tied to the AI trade and uses aggressive premium strategies to generate huge distributions. Now, this is not a core holding for me, meaning it's not in my top 3, but I do like it. It's a huge risk reward, and especially when fear is high and AI stocks are pulling back. So I'm buying this one every week, still dollar cost averaging. I'm not going super crazy, but I'm continuing to build this position. So I also want to be transparent and talk about ones that I'm watching and I have small positions in, but I'm not touching for now. I'm not going back into. But before I get into those, I'd love to hear what you're doubling down on, if anything, and what you're staying away from. Comment down below. I love hearing from you. I learn a lot from you, so would love to hear from you. So the first of those, and I've been a long time fan of this, ULTY. I want to see more stability in the NAV before I continue to build on this position. And like I said, I was a huge fan earlier in the year, but I have pulled back on building on this position and I haven't added to this position. I'm still in the green in terms of total return, so I'm keeping what I have now. There's no reason for me to sell it. It's generating enough income for me and it's paying back my investment and then some. So I'm in a holding pattern with ULTY right now. Next is HOW, which is the same story. It's high income, but I want a little bit more clarity on the market before continuing to add here. And literally doing the same thing. I'm not building on this position just like ULTY, but holding steady with what I have while investing in other things like QQQI, SPYI, and AIPI. There's other places I'm allocating, but I will save that for the next video on what other ETFs, income ETFs, and income stocks I'm investing in. Okay, and then the last one on this list I'm kind of staying away from. This was a core for a while, but I've actually traded out of a lot of my positions here, but I still have it, and that is BTCI. So I like the idea of crypto income, but the macro environment isn't right for me to size this super aggressively. I'm still a big fan of BTCI, but crypto has taken a beating just like the rest of the market. I'm not selling off. I'm just holding steady. So I'm not growing this position. I did move into other things, which I'll talk about in another video. And so from my experience, income is great, but income without stability is stress that you don't need. I don't need it. So like I said, I'm holding on to these 3, but I'm not adding more just yet. I'm not building on these positions. I'm building other ones during this downturn. With that being said, let me share one thing that helps keep me grounded during sell-offs. I think about the 2008 crash a lot. And after the 2008 crash, it's when the market dropped more than 50%. In the years that followed, that created more new millionaires than almost any other period in modern history. And not because they timed the bottom, not because they picked the perfect stock, not because they got lucky. It was because they kept buying when everything felt super, super uncomfortable. People who invested consistently from 2008 to 2015 saw 3x to 5x returns on broad indexes. They saw massive dividend reinvestment compounding, and they saw ways to lower all their cost bases across their portfolio, and more wealth than the people who waited for things to feel safe. And they built more wealth than the people who waited for things to feel safe again. The S&P 500 went from the low 700s to over 4,500 today. And that's a 6x increase. And that doesn't include dividend payouts. That's just on price appreciation alone. When people ran away, the disciplined investors built the wealth they're living on today. Continue to dollar cost average and buy at a discount. And down markets, they aren't the enemy. Fear is the enemy. Silence is the enemy. Inconsistency, buying high, selling low, that is the enemy. That's why I stay the course with my strategy. This is why I dollar cost average, and this is why I invest through the noise, because I've seen what happens on the other side, and it's life-changing. I was young and dumb in 2008. I didn't know what I didn't know, and I'm not letting that happen to me again. So just to wrap up, from my experience coaching leaders, high performers, clarity always beats panic. Down markets are uncomfortable, yes, absolutely, but they're also temporary. And your ability to stay consistent during these moments is what separates short-term anxiety from long-term wealth. I know I'm staying calm, I'm staying invested, I'm continuing to build my income snowball. So what are you adding right now? Drop a comment. I'd love to hear your strategy. Or do you think we're not going to hit the R word and this is just a temporary blip? I'd love to hear from you. As always, thank you for watching. If you got value out of this video, please, I'd appreciate it if you give it a thumbs up. Subscribe if you haven't already. It'd be amazing if you would share it with someone who needs it. I appreciate each and every one of you. If it doesn't challenge you, it doesn't change you. Messy action is better than no action, and I'll see you next time. Boom.